Are you in a financial situation where you're thinking about selling off some of your assets and you're wondering what the capital gains tax rate may look like if you're selling your stock or other assets? Well, I'm actually going to answer that question for you in this video so you can make sure that you are minimizing your tax impact while maximizing your profits and not overpaying Uncle Sam. But before we jump in, I want you to like, comment, and subscribe so I can keep you updated on all business changing information. And if you stay until the end, I will explain to you how not to pay capital gains on the sale of your property. So let's get after it. Capital gains tax is literally the tax you pay on the profit when you are selling assets. And I want to make sure I explain to you what assets are. Assets are things that make us money, like our real estate, like our investment in stock, like our investment in crypto. Well, kind of used to be, right? Hopefully that comes back. But those are what assets are, or any other type of asset that you may have. The capital gains tax rate really varies depending on how long you held on to the asset. And that is why it's so important that you understand capital gains tax rates when selling stocks or any other type of assets that need to be reported on your taxes. There is short-term versus long-term capital gains tax rates. So the first consideration has to be when calculating the capital gains tax rate is whether you've held the asset for a short-term period or for a long-term period. And here's the thing. When you are dealing with your assets, if you held it for 1 year or less, it is going to be considered short-term capital gains. And I do mean 1 year or less. So if you purchase an asset on January 1st of 1 year and you sell it on December 30th of the same year, even though it seems like a year, that is going to be a short-term capital gain. You have to literally hold it a year and a day for it to go into the long-term capital gains rates. And that is going to be very important when you're thinking about the tax implications on the gain on sale. When you have something that is sold on a short-term capital gain, that is going to be taxed at ordinary income tax rates. And ordinary income tax rates is what we pay every single day, which could range from 10% to 37%, depending on where we are in our income level. The long-term capital gains rates are the sweet spot. This is where if you've held that property for longer than a year, you might pay 0% income tax. You might pay 15% income tax. And at the top capital gains rate, you're only going to pay 20% versus if you were in the 37% tax bracket. So that's a 17% savings. Woo-hoo! That's really a big deal. That's why managing your capital gains tax rates and understanding it is mission critical. You also want to understand netting capital gains against losses. That's very important consideration when calculating your capital gains rate. You literally are going to net the gains against the losses. If you sold multiple assets during the year, you may have resulted in an overall gain, and some may have been in an overall loss. But you want to net those two together to reduce your overall tax bill. And I don't think many people understand that. For example, if you had a $10,000 gain on the sale of stock and the $5,000 loss on your crypto, your net gain would be $5,000. You would then use the appropriate capital gains tax rate to calculate the tax owed on the $5,000. That's why it's so important that we look at our taxes in the aggregate and not look at them in an isolated scenario. Reporting capital gains on your taxes is really key. because you want to make sure that when you report the capital gains, that you report it in the right place on the tax return. If you sold stock, for example, your broker should have given you a 1099B form. I know there's a lot of 1099 forms, but when you're selling stock, it's called a 1099B form. You really need to be on the lookout for this form. This form will literally list the details of the sale, including the purchase price, the sales price, and the date in which you sold it. This information is mission critical in order for your tax preparer to be able to properly calculate your gain on sale and to report it on Schedule D on your tax return. You will also need to report any dividends or other income you may have received from the sale of that asset on your tax return. Now, here's the thing. I want you to be very mindful that many times your companies that you invest with that send you those 1099Bs may not have your purchase price, your cost basis accurate. Very important that you track that information for yourself. Deductible expenses. The fourth thing I want you to consider when calculating your capital gains tax liability is deductible expenses. You may be able to deduct certain expenses related to the sale of the asset, such as brokerage fees, such as legal fees. These expenses can reduce your taxable gain and ultimately lower your overall tax liability. I don't think we think enough about the expenses we incurred to set up these brokerage accounts, or the expenses we incurred to pay the brokers all year long. But now's the time to go back and grab all of those expenses so you can literally utilize them to lower your capital gains tax rate. Tax loss harvesting. The final thing to consider is tax loss harvesting. This is a great strategy that you can use to offset gains by selling assets that have lost value. By selling these assets at a loss, you can use them to offset the gains and assets to reduce your tax liability. Let me give you an example. Let's say, for example, that I sold stock because I needed that money, right? That's the whole deal. We're in need of money. So I cash out my stock account. I have a gain and I'm making money off my stock. But I'm like, oh crap, now I have a gain. However, that crypto account that I started a few years back, it's at a loss. You may decide to liquidate your crypto account so that you can have that loss on paper and realize that loss so that that loss can go against the capital gains on the sale of your stock. This is called tax loss harvesting. And it's very important that you understand that. But I want you to be mindful that when you are selling your stock or selling any asset that you really want to hold in your portfolio, maybe you're going to sell your crypto because you want to realize those losses, but then you want to turn right back around and purchase that stock over again. You have to be careful of what we call wash sales rules. And wash sales rules mean that if I sell stock and I turn around and buy it within 30 days, that I'm not going to be able to take the loss, because IRS really doesn't want us flipping our stock so we can realize losses and then turn right back around and purchase it again. So you have to wait and purchase it 31 days later. That's the key. But here's the thing, my friends. If you are in a financial slinky and you need to liquidate your assets, and I know we've all been there before, you just want to be as mindful as possible to not only get as much money out of the sale of that asset, but also to minimize the taxes. You just want to be mindful of all the factors, and they include the length of time that you held the asset. They include netting capital gains and losses, making sure you report those gains properly on your tax return, and making sure that you take advantage of all the expenses that you incurred. And when you start to really factor all of those things in, you can really minimize your tax liability in a position you really don't want to be in, where you're liquidating your assets to have to pay your bills. But thank goodness you have those assets, because those are the reason why they're there, right? Here's the thing. I told you, if you stay until the end, how you can actually sell real estate and avoid capital gains. One of the things that you can utilize is a strategy and a tax code called Code Section 1031, where you can actually sell a piece of real estate and purchase another piece of real estate and get it tax-free. And if you really needed to take some money out of the transaction, you could. However, the money you take out, you will pay taxes on it. And now that you know better, you got to do better. That is why I want you to like, comment, and subscribe so I can keep you updated on all things tax.